Hi there, it's Friday the 19th of June 2020. I'm Steve Towers. Welcome to ITB. Let's get started. The US government dropped a bombshell this week by announcing that it will cease or pause its participation in Pillar 1 of the Inclusive Frameworks digitalisation project. Treasury Secretary Mnuchin sent a letter to the finance ministers of France, Italy, Spain and the UK, which has been reported as saying that the Inclusive Frameworks discussions on Pillar 1 had reached an impasse. Attempting to rush such difficult negotiations is a distraction from far more important matters. This is a time when governments around the world should focus their attention on dealing with the economic issues resulting from COVID-19. Discussions on Pillar 2 are on track and the countries are much closer to an agreement, which he hopes can be concluded this year. A US Treasury spokesperson described the US position as wanting a pause in the discussions. The OECD Secretary General released a statement which says that the discussions on both pillars will continue on schedule. Similar views were expressed by the European Commission and several EU member states, and also the view that implementation of digital services taxes should continue. As I reported in last week's ITB, the US Trade Representative has started a Section 301 trade investigation of DSTs in 10 jurisdictions. This current situation could easily trigger a US-EU trade war. A copy of the OECD statement is available on our website or app. Meanwhile, the African Tax Administration Forum has issued a policy brief to member countries in regard to digital services taxation in Africa. A copy of the policy brief is available on our website or app. The OECD has issued a questionnaire to members of the BEAC group in regard to the transfer pricing implications of COVID-19. A copy of the questionnaire is available on our website or app. US Trade Representative Robert Lighthizer has emphasised the need for reform of the WTO in a US Senate hearing on the US 2020 trade policy agenda. A copy of his statement is available on our website or app. In Australia, the tax authorities have updated their guidance on the mutual agreement procedure and arbitration, reflecting treaty changes pursuant to the MLI. The updated guidance is available on our website or app. In China, the government has announced the establishment of the Hainan Island Free Trade Port. The proposed tax incentives include zero customs duties, a 15% corporate income tax rate, and a 15% individual income tax rate. The announcement is available on our website or app. In Hong Kong, the tax authorities have issued guidance in regard to the profits tax treatment of financial instruments and foreign exchange differences. The guidance considers in particular the impact of Hong Kong Financial Reporting Standard 9 on financial instruments and Hong Kong Accounting Standard 21 on the effects of changes in foreign exchange rates. The guidance is available on our website or app. In India, the Bombay High Court has decided a case in regard to the carry forward of tax losses by a foreign entity which had changed its legal form. The foreign entity is the Aberdeen Delaware Business Trust, which, as the name suggests, was formed under the law of Delaware. The trust had 3 sub-trusts or funds: Asia Pacific including Japan, Asia Pacific excluding Japan, and emerging markets. These sub-trusts or funds were not separate legal entities. However, each of the sub-trusts or funds had different sets of investors. Also, for Indian regulatory purposes, each sub-trust or fund had its own sub-account registration, and the Indian tax authorities treated each sub-trust or fund as a separate taxpayer. In 2010, the Aberdeen Delaware Business Trust was converted into a Delaware limited liability company with exactly the same investors and exactly the same funds. Under Delaware law, the LLC is deemed to be the same legal entity as the trust. Prior to the conversion, the 3 sub-trusts or funds had incurred tax losses under India's tax law. The issue in the case was whether those losses could be carried forward for use by the 3 funds after the conversion. The court held that, yes, the losses were able to be carried forward for use by the 3 funds after the conversion. A copy of this case is available on our website or app. Also in India, the Delhi Income Tax Appellate Tribunal has decided a case in regard to the treatment under the India-Netherlands Treaty of outbound loan guarantee fees. An Indian company borrowed from a bank. The Indian company's Dutch parent company provided a guarantee to the bank and charged a guarantee fee to the Indian company. Under Indian domestic law, withholding tax applies to the outbound guarantee fee. The issue in the case was how the India-Netherlands Treaty impacted that withholding tax. The tribunal concluded that the interest article, Article 11, does not apply because the fee doesn't satisfy the Article 11.6 definition of interest, which requires a debtor-creditor relationship between the payer and recipient. And, not surprisingly, the tribunal concluded that the fee doesn't fall within the definition of fees for technical services, and therefore Article 12 does not apply. Interestingly, the India-Netherlands Treaty does not include an other income article, and although the parent company apparently has an operating business, the provision of guarantees is not an everyday occurrence in that business. Nevertheless, the tribunal didn't hesitate in concluding that the business profits article, Article 7, applies to the guarantee fee. And as the parent company doesn't have a PE in India, it's exempt from Indian tax. In other words, the tribunal resisted the temptation to conclude that in the absence of an other income article, the fee falls outside the scope of the treaty. A copy of this case is available on our website or app. In Korea, the government has announced various measures, including corporate tax measures, to dampen speculation in the real estate sector. The corporate tax measures are focused on companies which own residential rental properties, in particular, a significant increase in the rates of property tax levied on such companies and an additional capital gains tax on property sales by such companies. And also in Korea, it's been reported that the government has proposed a 20% tax on income derived from cryptocurrency transactions. In Malaysia, the tax authorities have issued guidance on the income tax treatment of the advance receipt of service fees before the services have been rendered. A copy of the guidance is available on our website or app. In the Philippines, the tax authorities have released a notice which directs all persons who are deriving income through any form of electronic media to register for tax purposes. However, despite the breadth of the direction, this is mainly a domestic issue. The Philippines law has not yet been changed to levy VAT on inbound digital supplies. A bill for that purpose is still in Congress. A copy of the authorities' notice is available on our website or app. In Austria, the government has announced a COVID-19 economic stimulus package, which includes the carryback of business tax losses to 2018 and 2019. A copy of the government announcement is available on our website or app. And the carryback of tax losses will also likely be available in the Czech Republic. A bill which provides for the 2-year carryback of tax losses to 2018 and 2019 has been passed by the lower house of Parliament. However, the carryback is limited to a tax loss of 30 million Czech koruna, which is about 1.25 million US dollars. Also, an estimated loss for 2020 can be included in the taxpayer's 2019 tax return. The European Court of Justice has decided a VAT case in regard to the delivery of goods from one member state to another. I've described the case here. Please hit the pause button to study this. A copy of this case is available on our website or app. In regard to Brexit, the European Commission has issued guidance on the operation of EU rules for VAT on services after the Brexit transition period expires, which will be on the 31st of December 2020. You'll remember that the Commission in April issued similar guidance on VAT on goods. A copy of this latest guidance is available on our website or app. The European Commission has proposed a further extension of the scope of the state aid temporary framework in response to COVID-19. You'll remember that this framework was originally adopted in March and extended in April. A copy of the Commission's proposal is available on our website or app. The European Commission has launched a public consultation on a review of the EU trade policy. Public comments are requested by the 15th of September. Information about the public consultation is available on our website or app. And finally, in the EU, the European Commission has published the documents from the most recent meeting of its VAT committee. The link to the database containing the documents is available on our website or app. In France, the Supreme Administrative Court has decided a case in regard to the dividend withholding tax exemption under the EU Parent Subsidiary Directive. The court held that, in the light of the ECJ decision in the T. Denmark case, a beneficial ownership test is a condition for that withholding tax exemption. A copy of this case is available on our website or app. Germany and Switzerland have signed an agreement in regard to the taxation of cross-border workers in response to COVID-19. This is the latest in a series of similar bilateral agreements between Western European countries. A copy of the Germany-Switzerland agreement is available on our website or app. In Poland, a court has decided an interesting case in regard to the definition of fixed establishment for VAT purposes. A Polish company operated a logistics business at its warehouse in Poland. The warehouse stored goods for a non-resident customer. The customer had no employees based at the warehouse, and the Polish logistics company's employees played no role in the sale of the customer's goods. The issue in the case was whether the warehouse constituted a fixed establishment for the non-resident customer. The court concluded, yes, it does constitute a fixed establishment of the customer. I think this case could end up in the ECJ. A copy of this case is available on our website or app. In Portugal, the government has presented a supplementary budget bill, which includes several tax measures. Two items caught my eye. Firstly, the carry forward of tax losses will be amended in a number of ways. Losses incurred in 2020 and 2021 will be able to be carried forward for 10 years instead of the usual 5 years. Also, in regard to such losses, the utilisation cap will be increased from 70% to 80% of taxable profits. And for pre-2020 losses, they can be carried forward without 2020 and 2021 being counted for the carry forward time limit. And the second item is the introduction of an investment tax credit equal to 20% of the eligible investment costs incurred, up to €5 million, in the period from the 1st of July 2020 to the 30th of June 2021. Any unused credit can be carried forward for 5 years. In the UK, the government has announced arrangements for border controls for goods imported into the UK after the Brexit transition period expires, which will be on the 31st of December 2020. A copy of the government's announcement is available on our website or app. And also in the UK, the tax authorities have issued guidance on changes to the partial exemption VAT treatment for the supply of goods by hire purchase, in light of the ECJ's decision in the Volkswagen case. A copy of the guidance is available on our website or app. In Pakistan, the government has presented its 2020 budget. Only one item caught my eye: the introduction of an interest expense limitation, effective the 1st of July 2020, based on the fixed ratio rule in BEPS Action 4. Only outbound related party interest payments will be restricted. The limit will be 15% of EBITDA. And banks and insurance companies will be exempted. In Saudi Arabia, the tax authorities have issued guidance on the mutual agreement procedure. A copy of the guidance is available on our website or app. In Chile, the tax authorities have issued guidance on the imposition of VAT on inbound digital services, which commenced on the 1st of June. A copy of the guidance is available on our website or app. And Costa Rica will impose VAT on inbound digital services effective the 1st of August 2020. The government has issued a regulation on this topic. A copy of the regulation is available on our website or app. In Mexico, the government has proposed a reduction in the standard VAT rate from 16% to 10% for the remainder of 2020. It has also proposed a standard VAT rate of 8% for the southern border region. The 8% VAT rate already applies in the northern border region. This proposal is currently before Congress. And now for this week's treaty developments. We've had one protocol signed and one treaty enter into force. In the first half of 2020 so far, I've covered just over 100 court and tribunal cases dealing with these topics: double tax treaty issues, transfer pricing, VAT, EU and EEA law. Obviously, there's an overlap between this topic and VAT, and finally, other domestic tax law issues. Starting today and over the next few weeks, I will review these cases and identify the ones which really stand out. I'll start today with double tax treaty issues. So far this year, I've covered 23 cases on this topic. Here's the first tranche of 6. Please hit the pause button to study this list. And here's the second tranche of 6. Again, please hit the pause button to study the list. And now the third tranche of 6. You know what to do if you want to study the list. And here's the final tranche of 5. Please hit the pause button to study the list. Well, in my opinion, from that group of cases on double tax treaty issues, one case stands out: Fowler, decided by the UK Supreme Court. I have 3 topics and 4 articles for you this week. The first article is called Globe Proposal and Possible Carve-outs. Is there a future for preferential tax regimes? It's written by Claudio Cipollini and it's published in the IBFD's World Tax Journal. As you know, the Globe proposal is reflected in Pillar 2 of the Inclusive Frameworks Digitalisation Project. During the public consultation in November 2019, it was suggested that there should be a carve-out to exclude from the Globe proposal preferential tax regimes which are in compliance with BEPS Action 5. This article explores that suggestion from a policy perspective, considering issues such as tax neutrality, tax equity, and tax sovereignty. In regard to tax sovereignty, the author concludes in this way: carve-outs are necessary in the context of the Globe proposal in order to ensure the exclusion of preferential tax regimes based on substantial activities from the scope of application of the minimum effective tax rate. Only in this way will it be possible to safeguard the tax sovereignty of all countries and at the same time the right to apply taxation in the country where profits and value are generated. The second article is called Applying the Arm's Length Principle to Group Synergies. It's written by Sebastian Mori and it's published in the IBFD's International Transfer Pricing Journal. According to the synopsis, this article deals with the basic antagonism between group synergies and the arm's length principle. On the one side, group synergies arise from the interactions between members of a group. On the other side, the arm's length principle is based on the fiction that members of a group operate separately, as if they were unrelated. The author concludes in this way: in the author's view, the only way of allocating group synergies in a fair manner is to have an allocation of profit, all or a portion thereof that includes profits resulting from group synergies, on a consolidated basis. In the author's view, a separated allocation of the benefits resulting from group synergies should be avoided. Pragmatic solutions should be found on a case-by-case basis, using concepts and approaches based rather on profit split, formulary apportionment, or game theories, to name but a few examples. The latest trends seem to go in that direction, And irrespective of all open questions and critical discussions around the latest OECD proposals about the digital economy, at least this development sounds a positive one. And the third topic has two articles, both dealing with the concept of fixed establishment for EU VAT purposes. The first article is called Fixed Establishment, From Berkholz and DFDS to Welmery and Dongyang. It's written by Krzysztof Lisinski-Selecki and it's published in the IBFD's International VAT Monitor. And the second article is called Dongyang Electronics. Oh yes, a subsidiary can also be a fixed establishment under EU VAT, but information asymmetries may save you. It's written by Giorgio Beretta and it's published in the Kluwer International Tax blog. Both articles discuss the Dongyang case, which was recently decided by the European Court of Justice. And interestingly, they provide quite different viewpoints on the decision. The Lisinski-Selecki article says this: in Dongyang, the ECJ generally followed the opinion of the Advocate General COCOT in this case. The subsidiary company can hardly ever be perceived as the fixed establishment of its parent company. This statement is true not only in the Dongyang case, but in general. The opinion of Advocate General COCOT in Dongyang should be very useful in the application of the concept of the fixed establishment. The Advocate General emphasised the need to interpret the concept of fixed establishment in line with the principle of legal certainty, so that taxable persons could easily determine the scope of their rights and obligations. Whereas the Beretta article says this: a subsidiary can also be a fixed establishment, FE, of its parent company under EU VAT after all. This is the most immediate conclusion as it emerges from the much-awaited decision of the ECJ in Dongyang. With its ruling, the ECJ quite unexpectedly revamped its nearly buried case law in DFDS, where the court had found that a subsidiary can indeed constitute an FE of the parent company insofar as the former acts as a mere auxiliary organ of the latter. Thus, the EU judiciary threw a punch at Advocate General COCOT. Well, that's the way it is this Friday, the 19th of June, 2020. I'm Steve Towers. Have a great weekend.